On PancakeSwap right now, you can make anywhere from 2% to almost 300% yield depending on the token pair. So why are those so different? Hey guys, this is how to make passive income on PancakeSwap. I'm going to show you how to add tokens onto the platform into some of these pools so that you can earn an annualized yield from the fees that are paid by traders. So we can put our tokens on and then earn those trading fees for our own passive income. I'm going to go through why there is such a massive discrepancy in the amount of yield we can earn between token pools and what the risks are for putting certain coins into liquidity pools in the first place. Timestamps for each section are in the description, going through all of the different aspects of actually putting liquidity onto the PancakeSwap DEX. If you've ever used PancakeSwap, you'll know it's an exchange where you can go and swap tokens. So if you link up your MetaMask wallet in the right-hand side, I've got a step-by-step guide for PancakeSwap in the description if you are a total beginner. But obviously this swap allows me to swap one token, which in this case is BUSD, into another token, which is US dollar Tether. I have Binance US dollar, so I can swap an amount, $50, into $50 of Tether because they're both stable coins, so they're both pretty much the same value. If I press swap right here, I'll swap those tokens, but I'll also pay a trading fee. Now, the trading fee doesn't go to the DEX, but it actually goes to the people that have put US dollar Tether on the DEX to make my trade go through. I need US dollar Tether and I don't have it. The people that put USDT on the DEX earn the trading fees for providing me the liquidity to trade my tokens. So here's exactly how that works and how we can earn those trading fees for passive income. Let's say I'm a trader and I have Binance coin, but I want US dollar Tether. So I'm going to sell some BNB into USDT right here. But I don't have USDT, but the liquidity pool on PancakeSwap does have USDT. So I just sell some BNB and the liquidity pool takes some Tether out and returns it to me. So I get the USDT right here. And obviously I pay a fee for doing this because it's an exchange. That fee doesn't go to PancakeSwap, but it actually goes to the person who put their BNB and USDT into the pool available for me to trade. So my fee goes to the liquidity providers who put their coins in the pool. We can do that and earn those trading fees. So how much can we actually make from putting our coins onto PancakeSwap? Luckily, the exchange tells us exactly how much. Come up to the three dots and go to info, and then you'll see all of the liquidity information. So what we can see down here is the top tokens on the DEX. These are the most traded. Now, no prizes for guessing that they will be BNB because it's the base layer coin of Binance Smart Chain. And then you have stable coins, which are always the highest liquidity. And then PancakeSwap, which is obviously the platform's token. So these are going to be the most actively traded. If you come down to here, top pools, here we can see the highest earning liquidity pools, the pools with the most liquidity. That's the most trade in and out every single day. On the right-hand side, you can see the liquidity. So this pool, the number one pool, which is US dollar Tether, a stable coin, versus BNB, it trades around $322 million per day. And the fees generated from that pool make out to be around 10.42% as a yield. So if you put $100 in over a year and you get 10% of that, so you'll make $10 from that 100 over the year. You know, if you can make 200%, you're going to double the amount that you put in over the year because this pool right here is paying 200%. Now, obviously, you can see there's a massive discrepancy in the amount of earnings and fees that are paid from each of these pools. Why is that? Well, firstly, you can see that this pool right here is extremely small. It's only got a liquidity of 1.34 million. And so the amount of trade and fees that are paid in relation to how much liquidity is in the pool is very, very high. So fees are paid on the amount of turnover of tokens, not the, you know, not kind of how much liquidity is in the pool. So you'll see that down here, almost 300% yield on here, but look at the liquidity pool size. It's absolutely tiny. You can see it at 750,000. So larger pools typically have lower rewards just because there's much more coins and the fees paid is a much smaller percentage of the total liquidity. Now, obviously, there's another reason here, and that's because risk. Pools that have assets that are similarly priced usually have very low rewards. and pools that have two assets that are more risky and more volatile in their price usually have higher rewards, and there is a reason for this. So before we get into actually putting some tokens on there to earn some fees, we have to look at the two different ways that you can earn income on any decentralized exchange, including PancakeSwap. One is with stable coins, or coins that have a very similar price and won't really change that much. The other is earning fees from two coins that are extremely volatile, and there is different risks with that. So if you use risk assets, for example, if we go over here and you can see that we have, FGD and BNB, it's a higher yield because these are two risk assets. If you see Move and BNB, these are two risk assets, a higher yield. You can see GMT against the stablecoin, it has still quite a high yield. And then we can come up to here to something like a stablecoin pair, right? Which are just $1 and $1, and that has a lower yield. So obviously we're seeing that more volatile assets should have a higher yield, and this is why. It's called impermanent loss. Impermanent loss is something that happens when you invest two high-risk assets into a liquidity pool. The price will change from when you put them in to when you take them out of the pool. And this will therefore suffer something called impermanent loss. You will lose money when you withdraw the assets if the price is different when you take it out to when you put it in. So when we're looking at the total return from a risk asset pool, you have to look at the yield that you get from trading fees minus impermanent loss, and that is the actual profit that you get. And you can see that here. If you put them in and they're $10 and $12, and then when you take them out, they're $10 and $12, you suffer no impermanent loss. If you put them in at 10 and 12 and they suddenly go randomly different, you can see here, the more that they change, the more loss that you will get. Now we can use a calculator to actually work this out as well. So we'll do that right now. So what you can see, this is an impermanent loss calculator. You can look this up, it's dailydefi.org. Let's say I put two stable coins into a liquidity pool and they're both $1 each. And then when I take them out, they're both $1 each. You can see the impermanent loss is 0. So all of the fees that I earn, I can just have that as they're the fees that I earn, and I will suffer no impermanent loss. Now let's say you have a coin that's valued at $100. Well, let's do $5, and you put it against a stable coin, and then the future price, let's say it goes up 5x, so now it's $25, and you see the stable coin is still $1. The impermanent loss, this is the loss that I will actually get when I take the coins out, is 25%. So if you aren't earning at least 25% from the fees in these pools, as you can see here, the LP rewards, if you're earning less than 25%, you will overall actually lose money. And so when you're adding risk assets, the impermanent loss is extremely difficult to work out because you have to predict a price in the future, and it can take away from the total return that you get. And that is why if you look at these very high yields, they can still be very profitable, but we have to take away impermanent loss and try and work that out before we put any coins into the pool. I'll quickly show you my thought process on this and how I go about this. So I'm going to come over to a liquidity pool, and I'm going to choose the most active pool, which is US dollar Tether against BNB coin. This is wrapped BNB coin, but it's the same value as BNB. And we're looking at a liquidity reward of around 10.5%. So I'm going to click on this right here. And what I'm going to do is come down and see the volume, and the trading volume is pretty good. Obviously, this is the highest active pair, and it does a lot of trading volume. That's very good, and a lot of liquidity right here. It seems like liquidity is going up over time. Now what I can see on the left hand side is that the LP reward is around 10% per year at the moment. So I can look at this and say, okay, I'm going to earn around about 10% by adding liquidity of this pair, US dollar Tether and BNB. I'm now going to go over to the impermanent loss calculator, and I'm going to work this out. Token A is BNB coin. It's currently trading around $400, and token B is the US dollar Tether right here, US dollar Tether and BNB. So that's that, and these are the current prices, $400 and $1. I know that token B, US dollar, is always going to be $1, and the future price of Binance coin. Now I think Binance coin, let's say I hold it for 12 months. How much can it go up and down in that time? Well, it probably has a plus or minus of, let's say 25% or 20%, right? So I would say 400, you're looking around about $80, something like that. Now, what I want to do is come down and see the impermanent loss. So that's 400 and then 480. Now, the impermanent loss here is 0.41%. So if I put the tokens in at this current price, 400 to 1, and I take them out at 480 to 1, I will lose 0.41% in impermanent loss. That's not a big deal, actually, for me. So if I go back and I can see that I'm earning a 10% reward, 10.42%, what I'm actually saying is we'll take away the 0.42% basically, and I'm going to be earning 10%. So if I provide my liquidity for a year, I think I'll be earning around about 10% as a reward. Now that's pretty good. If I have these coins anyway, and I want to start earning from them, 10% is pretty good. I know that staking BNB right now is around about 5%. And so I will actually earn more by putting my coins in the pool than staking. Now, here's the key difference as well. Staking is a guaranteed yield, because it comes directly from the blockchain. But what happens if I just get this totally wrong and BNB coin actually goes up to, let's say, 560, right? So now I'm making more impermanent loss. So I have to now minus 1.4% off of this 10.42%. Still, I think still worth it. I would say that's probably still worth it. If something goes crazy, and Binance coin goes up to 1,000, right? Now that's a doubling in price. Suddenly you've lost almost 10%, which wipes out all of your liquidity rewards. So as you can see here, this is a very stable pair. Binance coin is a big asset, and so it's not going to move a lot. But if you come down to pools, see some of these smaller coins like Move, like GMT, these can easily move 2 or 3x, right? 200 or 300% in a year. If that happens, you're looking at, crazy amounts of impermanent loss, like 40% impermanent loss. And so coming down here and seeing this liquidity pair actually earning around 36%, that could easily be wiped out. So the more stable the pair, the lower yield that you'll get, but also, the lower potential impermanent loss. And more liquid, more illiquid, smaller coins are going to pay a higher amount, but you're going to have to factor in a potential much higher impermanent loss. Now I'll show you exactly how to add liquidity onto the DEX to earn some fees. So come and link up your MetaMask. Like I said, I've got a step-by-step guide, like beginner's guide for PancakeSwap. I'll leave that in the description. And obviously you need some tokens in your MetaMask as well. You can get them in Binance, my Binance exchange. I'll leave some links in the description for that. But what we want to do is come over to trade, and then we need to come over to liquidity. So we're going to add our liquidity onto the platform. See, I haven't got any liquidity on here right now, but I'm going to click on add liquidity. And then I'm going to select a currency. Now I've got some Binance US dollar in my account, as you can see right here, about $103. So I'm going to click on that, and then I'm going to select the other currency. So this is the currency pair. Now I could select Cake, I could select Bitcoin on Binance chain, but I'm going to select US dollar Tether, which is a stable coin pair. And then what I'm going to do is click max. Now what I can see is that 103.85 BUSD turns into 103.71 USDT. I don't actually have enough US dollar Tether to work that out. So I'm going to click max on USDT instead, because this is valued slightly lower. That gives me 99.59 USDT, so I can afford that. And then that gives me 99.72 BUSD. They're just about 1 for 1. You can actually see down here, they're currently 99 cents USDT per BUSD, but about the same. So what I need to do now is enable USDT. I haven't actually enabled it on this wallet, so I'm going to enable it right here. You have to enable the tokens first. So go through to MetaMask. I'll pay 10 cents for that, so pretty cheap. I'll just wait for that to go through. If you need to do this for BUSD as well, you'll have to pay an enabling fee. So that'll be 20 cents for the pair. If you have some other tokens, obviously you need to do that as well, but you can see that's happened very quickly. So now I can come ahead and supply. So click supply right here. It's going to show me how many of each coin that I put into the pool and my share of the pool. This is really important. You have a share of the larger liquidity pool. So I'm just going to click confirm supply. You'll pay a fee right here. Click confirm. That's like probably 18 cents or something like that. Now it says, this is really important, add Cake LP to MetaMask. Really important that you do this. You now have these two tokens in the liquidity pool, and you have a percentage ownership of the whole liquidity pool. How much percent do you own? Well, you know that because you actually now get given another token called an LP token, or a liquidity provider token. This is basically a receipt, and it tells you how much of the pool that you own, so that when you come to withdraw your tokens, it will say, okay, we know that you own 1% of this pool, so we're going to give you 1% back. But also your fees are paid out based on how much of the pool that you own. So if the pool earns $1,000 and you own 1% of the pool, you'll get 1% of that $1,000. So I want to add Cake LP to MetaMask, and I want to click this. It says, do you want to add this? You can see I've already got it. I've added the token, but you can see it does have a balance now of 94 tokens. Now that just corresponds with $94 that I've put in the pool. So you get 1 LP token per dollar in this case. So I can add that, but I've already added it, so I don't need to. So I now have, essentially, those dollars are on the platform, and in my wallet, I have the LP token. We don't stop there on PancakeSwap though, because PancakeSwap has something called Farms, which is basically a way to incentivize you to use the platform, so we can use our new LP token to earn extra income by using the farms. This is how it works. So you can see here, I put Binance USD and USDT onto the liquidity pool on the platform. So I put them onto PancakeSwap platform, and I'm going to be earning 2.5%, as you can see here. I also get that LP token in my wallet that I can go ahead and use on PancakeSwap. What PancakeSwap does is incentivizes me by letting me stake the LP token, and it actually gives me more Cake tokens. Cake is the DEX token. So I'm getting another incentive in Cake tokens. How to do that? We'll come over to add liquidity again. Now what I want to do is come over to, I think it's earn, and then we'll come over to farms right here. So what you can see, now it should come up if I've got some staked. I just need to do that, and then I will search for them USDT, and we should get it here, which is BUSD USDT down here. So you click this. So this is the farm for the liquidity pool, that I've just added these tokens into, USDT, BUSD. I need to enable this, so I can do that. Then we go through and click confirm. Now this is going to start paying me more in Cake tokens on my LP tokens, and you can see the APR for this is about 7%. So take the 2.5% that I'm getting from fees plus the 7% more or less in extra tokens, and obviously that's 9.5%. So I'm going to stake LP. You can see I've got 94 LP tokens. They're the tokens in the wallet, so I'm going to click max, and you can see this staking, so I'm going to confirm that. Obviously go through and pay the fee again, click confirm. Now what I'm doing is earning a yield, and this is an incentive based on how many LP tokens that I have. So once that's gone through, I would actually be earning around 8% in Cake tokens. So you're not earning USDT, you're not earning Binance US dollar, you'll be earning Cake. Now what you can see down here, my LP tokens are staked. I've got 94.36 LP tokens, and that's worth about $200. That's $100 of each, more or less. And then the amount of Cake that I'm going to earn, that will rack up tick by tick based on 8% APR. Now, after a while, you can just click on harvest and harvest that Cake. So you will actually get Cake in your MetaMask wallet. You can keep that Cake if you want, and Cake is a risk asset. It's worth about $10 at the moment. It can go up and down. Or what you can do is actually sell the Cake into more US dollars and put those US dollars back into the liquidity pool to get more LP tokens, to then put them in the farm and keep that rolling over and over again. The other way that you can earn passive income on the DEX is using pools. Pools is simply where you take the Cake token and then put it in the pool and you get another token out. So if you come to earn and then pools, this is not providing liquidity. This is where you just have Cake and you put it, basically stake it in the pool and then earn other tokens. So you can see I've done this for a few days ago with some Cake tokens right here, and I'll show you how this works. So you can just stake Cake tokens, and that's it, and they'll just pay you an APY. You can see the APY is 78.68%, which is insane, obviously. And the amount of total staked is obviously very high. Come and enable the pool again and add some Cake. Now, this is just a very simple APY that they pay you. Now, if you come down here, what you can do is actually stake cake tokens and then get other tokens as a reward. Again, this is just a reward to, you know, incentivize liquidity onto the platform and get tokens out to different people. Anchor is currently paying 91% APR. Now, there's a max stake per user of 100 cake. So this is like a small incentive to just basically diversify the asset base. And this is a short-term incentive, and the incentive will obviously stop in around 2,500 blocks time. So you can enable this, stake some cake, and actually earn Anchor in return. Now, you may say, why is the yield so high? This is ridiculous. Well, firstly, like I said, you get an APY of 80%. Most of this comes from new token creation. And so it's not a real APY, right? Because they're paying out 80% in APY. They're also diluting the asset base by around about 80%. So it's kind of like break even possibly. Now, if you do this, some of these coins will actually just be staked again by stakers and not sold. So there may actually be a net positive of getting these tokens, but it won't be 80%. It might be something like 5, 10, 15%, or, you know, somewhere around there, which is still obviously very good. And if you've got cake tokens anyway, stake them in here to earn more of them, or put them in the, you know, the other liquidity pools to earn some trading fees from those. So to recap all of the ways that you can earn, plus the risks of them, firstly, if you LP stablecoins, this is about as low risk as you can get in DeFi because there's no impermanent loss, but you're also going to get a low reward in terms of the payout from fees, around 2.5% on PancakeSwap, but you can stake your LP tokens in Cake to get those increased yields, which is, you know, around 7% on PancakeSwap. You can also sell Cake to lock in that yield if you want, or you can actually keep the cake and then stake the cake for 70%. But obviously that's just the APR and not the total yield. So you have to work out, you know, which one you think is going to pay you a total return that is better. The other way is to LP risk assets. This is high risk with an unknown reward because you don't know what the risk assets are going to do. So you do know the reward in terms of the APR, but the impermanent loss you don't know. So this is definitely higher risk. Higher volatility and smaller pairs definitely require a higher yield because that impermanent loss may happen. And of course, you can still stake your LP tokens in the cake pools to increase the yield further and, you know, further make smaller the possible impermanent loss. And then obviously you can just stake cake tokens to either earn extra cake or, you know, some other tokens that are in the cake pools. Come and join the public Discord server if none of that made sense. I'll pin it as a comment. Also, you can check out my crypto investor course if you really want to get pro and understand all of the different nuances of providing liquidity on DeFi. I'll link that in the description as well. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.